Hello, Edyard Denny here. Thank you all for joining me today. Hope you had a good weekend, and we can look forward to a better week or continuation of the somewhat better environment we've had over the past several days in the market. It's interesting that the market has held up remarkably well in the face of the banking crisis. But then it's not the first banking crisis we've ever had, and we have seen regulators sort of jump in and do what they do, which is regulate and supervise. And when the regulations and the supervisions don't work, these regulators have the power to do something about it. So, for example, with regards to the Fed came in on Sunday, March 12th, with a emergency liquidity facility for the banks, and that seems to have calmed down. As you know, the Fed is not in a position to increase the amount of insurance on deposits, which is right now set by the FDIC at 250,000. I believe that has to go through Congress. I don't think the FDIC has the power to just say, okay, let's make it 1 million. But the Fed indirectly guaranteed 100% of deposits to 100% of depositors simply by providing that liquidity facility, so that if there are bank runs, more bank runs, the banks can run to this facility and basically put up collateral at par, not at market value, but at par, to get some liquidity, some funds. And very often when the Fed in the past has created these liquidity facilities, they've had the tendency to calm things down, and sometimes they weren't even used very much. So maybe we'll see that unfolds again this time. Meanwhile, the FDIC is doing its job. It basically sold the Silicon Valley Bank. And I think the cost to the deposit insurance fund, the Federal Deposit Insurance Fund, is going to be about $20 billion. So it's a lot of money, but it's not necessarily the price, because the FDIC kept some of the assets of SVB, and we'll see what they can sell it for. We had a similar situation with the savings and loan associations back in the late 80s, early 90s, and the government created something called a Resolution Trust Corporation, which sold off the assets. And there were a lot of S&Ls back then, and despite that, we didn't have a financial meltdown. We did see problems in the commercial real estate market. We did have a recession in the early 90s, but it was actually a pretty mild one. And all in all, that was handled pretty well. And I expect that this banking crisis will also be held relatively well. I hope I didn't just jinx it, but that's my opinion. As you know, the bears are still growling out there that this banking crisis has got a long ways to go, that it's going to be similar to the great financial crisis. I don't know. I don't want to put words in their mouth. I don't know if they've actually said that, but it certainly sounds like they're thinking that it could be. And you can be sure that they will be growling louder and louder if, in fact, it starts to play out in that kind of direction. But the bearish case now is that the banking crisis is something that breaks when the financial system when the financial system is under duress from tighter monetary policy, and that what happens then is that when something breaks in the financial system, before you know it, it becomes a financial contagion, a credit crunch, if you will, which then turns into a recession. So the bears are still saying there's a lot more downside in the valuation multiple for the S&P 500, and there's more downside, a lot more downside for earnings, and the bear market's not over. And as a matter of fact, its imminent return is likely, as is a recession. Meanwhile, the Atlanta Fed's GDP tracking model for the first quarter is tracking at 3.2%. I looked at it this morning. That was as of March 24th, which is the latest update of the tracking model. The thing that really blew my mind is consumer spending, inflation-adjusted consumer spending. So far is tracking at an increase of 5%, which is pretty remarkable. I don't know if you noticed, but the January retail sales report was up 3%. It was actually revised up to 3.2%. And then there was a modest decrease in February. Well, what do you expect after that kind of hip, hip, hurrah, hooray, I should say, in tomato, I guess. The first quarter consumer numbers so far, based on what we have, are pretty strong. And by the way, the flash estimate for the PMI for both manufacturing and for services that S&P Global puts out came out at the end of last week, and they were both moved higher. The services, I think, moved back above 50. Manufacturing still below 50, but it moved higher. And so this is, we're in March, and it's March flash estimates, and it suggests that the economy is doing pretty well. On the other hand, there are these regional business surveys, which aren't looking so good. They do tend to be very heavily skewed towards manufacturing. And, we've been discussing for a while that we have a rolling recession that's rolled through single family housing, not multifamily housing. It's rolled through goods, retailers and producers, which is why the PMIs have been weak. But the services PMI have been fairly strong and have supported consumer spending. We are seeing probably some issues in the commercial real estate market up ahead here. But meanwhile, the construction data shows that there's manufacturing spending. The spending on manufacturing facilities is very strong, and that may very well reflect, maybe it's too early, but it may reflect to some extent the money that the government is spending along with private industry on building chip facilities in the United States. And of course, there's a lot of onshoring going on, building battery plants and so on here. So that's an offset to the commercial real estate. And some of these commercial properties that are under duress are being converted into multifamily housing. There's a limit to how many of those can actually be converted. So there's still going to be a problem in that area. But it still looks like a rolling recession to me. And as I wrote in the morning briefing, I've gotten questions for some of our readers wondering why I didn't raise my odds of a recession. Why I didn't raise my odds of a recession. Sorry, I missed a little. Why I didn't raise the odds of a recession when the banking crisis unfolded on March 9th and 10th. That was the Thursday and Friday. And why didn't I spend the weekend thinking about how things could kind of fall apart into a recessionary scenario? Well, my comeback to that question is that, I have been arguing that there's a 60% likelihood of a soft landing and a 40% likelihood of a hard landing. And I think those were realistic assessments of what we're dealing with here. I wasn't totally naive and Goldilocks about the recession risk. 40% is a fairly significant risk. I was pointing out that inverted yield curves have a history, a pretty consistent history of anticipating financial crises, then that leading to credit crunches and that leading to recessions. So I'm not real surprised that something broke in the financial system, but so far I'm resisting the notion that it necessarily has to morph into a credit crunch into a recession. And as I've been saying for a while, we've been in a recession for a while. We've been in a recession since early last year, but it's been a rolling recession, and nothing that's happened recently suggests to me that that can't continue. I should, it's not as though nothing has happened. Obviously, the banking crisis has happened. And like everybody else, I've suddenly become an expert on the H.8 release that the Fed puts out at 4 p.m. on Fridays. So I guess a lot of us were kind of used to the market closing at 4 and then taking, kind of decompressing, going home and resting for the weekend, maybe doing some reading to keep posted, reading the morning briefing to keep posted on how things are unfolding. But now we have to spend a little bit of time looking at that H.8 release because what it shows is the assets and liabilities of the commercial banks on a weekly basis. And we just got the March 15th data, which is the first weekly data that includes the SVB, the banking crisis. So let's have a look at that. Let me share my screen with you. Here we go. Let me start out with a little drink of water here. Okay, so we're here on March 27th. This is the morning briefing charts. Start off with just a chart that I like to look at on a regular basis, simply the S&P 500 versus its 50-day 200-day moving average, and then it's where it was at the end of the prior year, and seems like we're finding some support there. That doesn't necessarily mean that it's made out of concrete. The bears are arguing that we're going to crash through that and be testing these levels down around 3,500, 3,600. They have a plausible scenario. I won't say that's not plausible, but it's just a matter of a difference of opinion in terms of what the probabilities are. As you can see, we're sort of, at least on Friday, we were between the 200-day, we were above the 200-day and above the 50-day and below the 200-day. Did I get that right? You'll look at it, you'll figure it out. As you can see, I mean, maybe we're going to be debating this bull versus bear debate for the rest of the year, and all we're going to do is go sideways. I'll admit that's a distinct possibility. But I think on balance, now that we've had this banking crisis, at least I think that the Fed is most likely done raising interest rates for a while, and the bond yield will probably stabilize around this. Let's make it 3 to 4%, just so I have a lot of room to wiggle with. But I think about 3.5%, maybe plus minus 25 basis points. But the reason the market's held up so well in the face of the banking crisis is because I guess crises are good for the mega cap 8. We had the pandemic back in 2020, and the mega cap 8 did extremely well. They were clearly beneficiaries of the pandemic in terms of they had a lot of goods and services that were in high demand during the lockdowns, as well as the gradual opening up of the economy. And now we've got another crisis, this banking crisis, but they were actually doing pretty well since late last year, the mega cap 8 were. And as you can see, I think all 8 of them had some issues, and all 8 of them's managements kind of jumped in and started cutting costs and doing some things that got people excited about their prospects again, including a lot of hype about artificial intelligence, which may not be hype. I mean, it's pretty interesting. I've been looking at Jackie and I've been looking at Chat GPT-4, and it's actually pretty clever. But while it can do a lot of writing for us, we're still going to have to double check, and it would be kind of useful if it provided some references for its conclusions. But anyways, you can see that the market has been very focused once again on the mega cap 8, while the rest of the sectors have actually been down. So the mega cap 8 are in technology, they're in communication services, and they're in consumer durables, and they gave lift to those sectors. Here's another chart that Joe puts together. Joe Abbott, not Joe Feshbach. Joe Abbott regularly updates this chart, I think once a week. And as you can see, there's been I think it's a 26% increase from the bottom in the mega cap 8's market capitalization, and basically no increase in the S&P 500, excluding the mega cap 8. So that's a wonderful thing about our business. There's always something to invest in, and right now the mega cap 8s are beneficiaries of this crisis. Plus, well, why is the crisis helping the mega cap 8? Well, as we've seen, they are very sensitive to bond yields, and the bond yields have come down, so that's helped on the valuation side. And then the artificial intelligence story has helped on the earnings expectation side, or at least on the hype side. So the forward PE of the mega cap 8's not cheap. It's back up to 26.8. On the other hand, ex mega cap, we're down at kind of fair value 15.4 for the forward PE. So when you look at the 17, a number like 17, which seems relatively high and uncomfortable, don't forget to look at the components and recognize that the market's telling a fairly bullish story on the mega cap 8. Now it is, anyways. So as I said, the H8 release comes out on Fridays at 4 p.m. we'll be slicing and dicing it. Most likely we'll be putting out these quick takes to get the word out quick on some of these issues, and then have a more in-depth look at it in the Sunday advance for Monday's morning briefing. But here you can see that the data is available through March 15th. This is total deposits. Everybody's going to be looking at that for bank runs. And what we've seen is that money did come out of small banks. Money did come out of, by the way, this just shows small banks and large banks, but they're domestic banks. The total here includes also foreign branches of foreign financial institutions. And so the deposits came out of some of the foreign financial institutions, but there was some money that went into the larger banks. I think on balance, there was a $98 billion outflow. Well, where did it go? We'll be also watching, as everybody else will be, the money market mutual funds. The institutions decided that maybe they wanted to move out of some deposits in order to make their payrolls. They wanted to make sure that they have the money. And so they seem to have moved some money here into the money market funds. And this has been going up all along, reflecting maybe some disintermediation. The idea that if interest rates in the money markets are higher than they are on deposits, you're going to have people moving out of deposits and into the money markets. This is going to continue to be an ongoing problem, and the only way that the banks are going to solve it is by raising their deposit rates, which then is going to squeeze their profit margins, the profitability. Then again, while that sounds pretty bearish for the banks, we may be in an environment where we're going to see a tremendous amount of M&A activity, a lot of mergers among the regional banks to shore up their balance sheets and increase confidence. They're also going to be regulated more and supervised more, and I think they'll welcome that as a way to shore up confidence in the business they're in. But look, I think I'm a free market kind of guy, but I think banks need to be regulated like utilities. They are dealing with OPM, other people's money, and they lose sight of that fact and start to become too speculative. They don't manage things properly, and before you know it, they're risking OPM, which is the deposits, and then the regulators come in, and we have a situation like what we have now. But this is a very dynamic environment, and again, look for a lot more M&A activity to offset concerns about disintermediation and about profitability. Borrowings, commercial banks borrowings, that's a level. It's not a flow, it's a stock. It's the amount of borrowings. It's on the H8 release, and you can see that went straight up. And a lot of it could have been SVB, actually. SVB, before this all started, had $200 billion in assets and about something like $190 billion in liabilities. So we'll be watching to see how that plays out. But some of that, I think 30 billion of that, was in this new banking liquidity facility. And that data is available on the H8 as well, and we'll be looking at it. Securities. This is kind of in some ways, the heart of the problem, right? Interest rates went up. There were losses incurred on mortgage-backed securities and treasury bonds, agencies that were bought by these banks. And because if they categorize them as held to maturity, apparently that doesn't cause an imminent death threat to the institution if they hold them to maturity. But then if you have a deposit run and you have to sell them in order to meet that, then you got a problem. But that's the point of the bank, the Fed's bank liquidity facility, is that you can now take your bonds at par, not at market value, and trade them in or park them at the Fed in exchange for liquidity. So I think that's stabilizing the situation. It's all a matter of confidence, and if the confidence doesn't erode any further and actually makes a comeback, then we should be able to get through this banking crisis without a credit crunch. That's my view. Loans and leases, we'll be watching that. That's where if there's a problem on deposits and because of the banking crisis, banks get more conservative. Let's, the C office executives say, freeze, we're not making any loans until we see how this all unfolds on our deposits. Even with the bank being backed up by the Fed's facilities, then we would see that bank loans start to decline, certainly don't go up, and that would be clearly a sign of a credit crunch. The US does depend a lot. In the US, we depend a lot on banks for credit, but there's also very vibrant capital markets, maybe less so in the private equity sector right now and private debt sector. And there's still a lot of liquidity left over, I think, from the what was accumulated during the pandemic, and a lot of debt that was refinanced at record low mortgage rates. Then there's loan and leases by categories. We'll be following that. The big concern is commercial real estate. This is commercial and industrial loans. That's business loans, residential real estate. The commercial real estate, as you can see, is the green, and it's actually been going up pretty significantly here into new record highs. And we did look at it also by large banks and small banks, and you can see that the small banks are very have a lot of their portfolio. They're not bigger than the large banks. By the way, the large banks are the 25 largest banks, and then everything else is in the small banks category. So you can look at that on your own. Banks share as a percent of total banks, since that's where the vulnerability is. What could the vulnerabilities be? We'll be watching that. Interestingly, this is through March 15th, and so the bankers presumably, this is Wednesday data. So the bankers presumably had a couple of days over the weekend and a couple of days at the beginning of last week to assess whether they need to provision for loan losses. And as you can see, they're really not doing much. They didn't do much during that period. So far, this is really not so much a matter of credit quality as it is a liquidity issue. So maybe that could explain it. So that's a run through of what we did on Monday. For tomorrow, I'm working on would you know, Chloe just arrived. We'll see if I have to let her out in a minute. I'm working on the rolling recession ID, the question of the extent to which the bear story makes sense. It makes sense, and why I'm not in that camp. So with that, let me take a couple of questions. Michael, how bad will the commercial real estate issue be? Is it priced in? Are commercial real estate debt REITs a buy? Yields above 10%, which is either great or a warning sign. Yeah, I'm no expert on REITs, but or commercial real estate for that matter. But it's you don't have to be an expert to know that financing rates have increased dramatically. That only exacerbates the problem that they have with offices being office leases. Once they expire, they're probably not going to get renewed, or they'll get renewed for half the space. I think it's a major issue in the credit markets, and it's a major issue for the economy. But it's a big economy, and it's a big capital market, and I don't think it's big enough to really cause an economy-wide credit crunch or a recession. As I said, I put it into the rolling recession ID. What's the difference? This is a Zoom user, okay, unidentified. What's the difference to the markets of a rolling recession versus a heavier recession? Makes a big difference, I think. I think if we were actually going into a recession last year or early this year, the bear market would certainly, I wouldn't be arguing that the bear market's over. I think the S&P 500 bottomed on October 12th. So I'm in that camp that thinks we made a bottom there, and that we've been in a bull market since then. Not a V-shaped bull market, not straight up, but one where there are opportunities to buy stocks, and where the macro environment is not so negative that you can't find companies that are making money. Rolling recession means there are some areas of the economy they're doing well. I doubt very seriously that the mega cap 8 would be doing well if we're heading into an economy-wide recession. Doug, normally a banking crisis trails a recession. True. Does the leading banking crisis led by deposit disintermediation cause you any concern? And what will a normal banking sector look like? Are we marching inevitably to an 8 sci-fi banking world? I'm not quite sure what 8 sci-fi is, but that's okay. Look, we've had disintermediation recessions before. We had a kind of a weak rolling recession in 1966. Then in the 70s, when interest rates jumped up, especially under Volcker, money poured out of S&Ls, and every sector that they lent to, and a lot of that was commercial real estate, went into a recession. So actually, disintermediation has caused banking crises, and it's been a leader in terms of it happened first, and then the recession happened. So I think the environment we're in now is sort of like a disintermediation environment, where I think the banks are going to have no choice but to increase their deposit rates. That'll squeeze their profitability. So I think it's really more a profit issue. But as I said, rather than concluding, therefore, you want to be out of these stocks, you have to be alert for the fact that there could be a lot of mergers and acquisitions, which will make for more interesting stories. Let me put it that way. Brian, do you worry about stagflation with the current environment where inflation stays high, but the economy just remains flat? Actually, this is an interesting environment we're in, where the rolling recession and some crunchiness in credit. I mean, I'm not going to tell you that nothing's happened here. We've had a banking crisis. It's going to have some consequences in the credit markets. But all that may actually help to continue to bring inflation down. So I think we can, in other words, I'm still sticking to my story here. And that is a 60% chance of a soft landing. And, I've made the distinction between how much of that is just, kind of a immaculate disinflation, and how much of that might be a soft landing with that's a little bit tougher, but nonetheless, where we don't have an outright recession. So I would say that stagflation is not something that I think is very likely, but we'll all watch it together. Gus, Ed, if Japan and China were our biggest buyers of 10-year treasuries, if they are no longer there buying, won't we have to revert to quantitative easing in the future? One of the things I've observed over the years is that it's hard to predict the bond market using supply and demand analysis. The bond market seems to be much more focused on inflation and how the Fed will react to inflation. So I think we've already gotten a reaction from the Fed. I mean, Powell did say at his press conference that he kind of said it, it wasn't anything that they did a lot of research on, but he said that he thought that the banking crisis could be equivalent to 2 rate hikes. In other words, 50 basis points is what he thought. I think it could have been more like 75 to 100 basis points. But at any rate, having him say that is basically acknowledging that interest rates are at restrictive levels, and that they're already where they want it to be, which is restrictive, and then just leave it there and let it be restrictive to slow the economy down and bring inflation down. So I don't know that Japan is really getting out of treasuries. Maybe they are, but the Chinese, for geopolitical reasons, maybe so. Oh, it's a good thing we're almost done, because Chloe's right there. Let's see. Say hi, Chloe. She's shy. How do you like that? She doesn't want to be a TV personality. I'll take one more question here. Okay, Nick, the gold price is up almost 10% year to date. Do you have a view on its direction from here? Well, I think the banking crisis has gotten people excited about gold and even Bitcoin. The idea being that There's something wrong with fiat currencies. There's something wrong with the banking system, and that you don't want to be dependent for your means of exchange on just having dollars or any currency. So I think that's kind of got people excited about gold and Bitcoin. What can I tell you? Bitcoin is just is not my thing. It's something I watch as a just an observer, and what I observe is it's very volatile. Gold tends to have an inverse relationship with the TIPS yield, but it also tends to be an indicator of what the underlying trend is for commodity prices. And neither one of those models, I think, is particularly relevant right here. I think it's more the bank run story that if you have bank runs, you want to own gold. So it is what it is, to the extent that the bank crisis simmers down, which is what I think it'll do, then that'll should take some of the excitement out of gold. So gold was a great place to be a couple of weeks ago, but now I'm not so sure. I mean, clearly, if there's a whole slew of bank run announcements up ahead, but gold will do very well, but that's not what I'm anticipating. So what I hope you do is have a good week, both at home and at work. Sometimes they're the same location, I guess. And let's do this again next week.